Good morning, everybody. I'm Frank Kapitza from Frank Kapitza and Associates. And this webinar today is based upon IRS penalties and how to avoid them. The biggest IRS penalty that there is the failure to file penalty. And I think that's really profound. Just by not filing your return, you get hit with the biggest penalty that there is, which is 5% per month. Now think about that. You owe $10,000 in tax. At the end of the first month, you owe $10,500. At the end of the second month, you owe $11,000. And at the end of 5 months, you'll owe $12,500. That's outrageous. The next steepest penalty is the failure to pay penalty, and that's only at 0.5% per month. Now think about how profound that is. The failure to file penalty is 5% per month, and the failure to pay is only 0.5% per month. The failure to file is 10 times greater than the failure to pay. You would think it would be the other way around, wouldn't you? But it isn't. So the simplest thing to do is just file your return. Here's what usually happens. Taxpayers get a return from their accountant that shows $10,000 owed. And then they do the ostrich in the sand thing and say, well, I can't pay the $10,000. So I'm not going to file my return. I'm not going to pay the tax. Well, not paying the tax is okay. You heard that correctly. But file the return. Because in 5 months, you'll only owe 2.5% of a penalty on the failure to pay versus a 27.5% penalty for the failure to pay and the failure to file. So to recap this, the biggest IRS penalty that there is the failure to file penalty, and that can be so easily avoided, with the solution being just to file your return. And it can even be incomplete, because if you're missing documentation, file it as is, and then the IRS allows you to amend the return afterwards when you have all the complete information available. And again, and if it is complete, still file the return with whatever balance is owed, because then you'll only be hit with the smaller of the two penalties and the interest that's applicable to that. The next penalty is the estimated tax penalty. The estimated tax penalty is profound. You have to pay your taxes during the year. And that's because the government on a macro level is like we are. How would you like it if you were working for me and you were going to get paid $2,000 a week? And every week I went up to you and said, well, you're not going to get paid this week. And at the end of the year, I'll give you $100,000. You'd be like, you got to be kidding me. How am I going to pay my bills? I have a family to support. The government's the same way. We have a pay-as-you-go system. And if Americans didn't pay as they go with withholding on their paychecks, I'll tell you, this country would be broke, because there's no way somebody making $60,000, $70,000 per year could afford to pay $7,000 or $8,000 on their tax bill all at once at April the 15th. If you don't pay during the year enough, the IRS considers that as you taking an involuntary loan from them. You didn't ask for the loan, they didn't grant it, you just took the loan yourself. And if you do that, the IRS charges you a penalty and interest on top of it. So it's important that you pay the right amount during the year so you can avoid that penalty. Now, the tax is the tax. You have to pay it, you have to pay it. So that's why it's important to pay during the year, because it's a matter of timing. You can avoid that penalty very easily as well. The next penalty is the accuracy penalty. If you file your return and the tax is obscenely low, or it's a negligent return, the IRS will hit you with a 20% penalty on top of the correct tax. That could be a huge problem. Okay, a $10,000 tax bill. If you filed a return and you said you owed $4,000 in tax, the IRS could recompute it, and it could now be $10,000 in tax, and they'll charge you a 2%, a 20% penalty. And they could even charge you a 25% penalty for a failure to file and another 2.5% penalty for a failure to pay. You can see how these penalties mount up. And then there's the interest rate, which is now 7% on a daily basis. 7% doesn't seem like that much, but when it's compounded on a daily basis, it turns into a big number. The last substantial penalty is the documentation penalty. You need documentation for almost everything that you spend money on, unless it's something like for a parking attendant for a tip. If you don't have that, the IRS will disallow the deduction. So this is important because I had a doctor as a client once, and you know how doctors are. They know everything. So what this doctor thought was that when he went to Staples, all he had to do was show the IRS a credit card statement that said the word Staples on it that showed the amount. Wrong. The IRS will not accept that. They want to see a credit card statement that says Staples. And they also want the receipt so you can validate the deduction. Now think about that. Somebody could be buying school supplies for their kid, which is really a deduction that's not permitted because it's not used for business. But they will pass the IRS test of substantiation if they have the credit card statement that shows Staples and they have the receipt key for the office supplies that they ended up using for their kid. Meanwhile, the doctor just had a credit card statement that showed Staples, and he had a valid deduction because it was used for business. But because he didn't have the credit card statement receipt, deduction was disallowed by the IRS on audit. Here's the easiest way to avoid that. Buy a red rope. Take any receipt that you have. When you get home, empty out your wallet and just throw it into the red rope. And label it by year. 2025, 2026, 2027. Don't even organize it. Because when you get audited, half the problem, or I should say 90% of the work, is gathering those rosebuds and finding the documentation that you need for the audit. If you throw it all into one red rope per year, you're going to save 90% of your time. Because even though it's not organized, it's all going to be in one place. And that's just something I recommend to my clients so that in the event of an audit, things go much easier. If all this got you depressed, there is penalty relief based upon reasonable cause in many cases. That's a whole separate area that I can't really go into right now. But also, beginning in this summer of 2026, the IRS has got a new program based upon compliance, whereby if you were compliant for 3 years in a row, you can waive the penalty for failure to file and failure to pay, which is, I think, a great thing because the taxpayer was good for 3 years, and basically they screw up 1 year. Now the IRS will take that into consideration, which I think is the right thing to do. So to sum up, the most important thing that you can do to avoid IRS penalties is simply file your return. You'll save 5% of the tax per month, and you'll save 25% of the total tax in 5 months. That's the easiest thing you can do to avoid it. And for anything else, as far as penalty relief and what have you, I can talk to you about that separately. You just need to call the office, talk to Erica, and she can book a free half-an-hour consultation with me, and I can discuss how you can basically take the penalties and possibly reduce them or even avoid them. So again, I'm Frank Kapitza from Frank Kapitza & Associates. I thank you all for listening to my webinar, and I look forward to doing another webinar with all of you soon. Thank you. Take care. Bye.
Because more people are joining it now.
Okay. Just restart it?
Yeah. Go.
Okay. Hello, everybody. I'm Frank Kapitza from Frank Kapitza & Associates. And my speech today, or webinar today, is about saving IRS penalties. The biggest penalty by far is the failure to file penalty. And that penalty is 5% per month, not to exceed 5 months or 25%. That penalty is profound. If you owe $10,000 in tax, at the end of 5 months it'll be $12,500. Then the failure to pay is 0.5% per month, and that would be another 2.5%. And then there's interest at 7% per day compounded that'll add to that total. The solution to avoiding the most costly IRS penalties that there is to simply file your return. It's that easy. Here's what usually happens. People get their tax bill from their accountant and they see $10,000. They panic. They do what I call, they do the ostrich in the sand thing. They put their head in the sand. And when that happens, you know it sticks out. They don't file the return. They don't pay their tax. It's okay not to pay your tax. You heard that correctly. But file your return. There you'll save the costliest penalty that there is. And the only thing that you'll be charged for is obviously the tax itself, the failure to pay penalty, which is only 0.5% per month, and the interest that's applicable to it. But you'll save $2,500 from the costliest penalty and the interest that goes on top of that penalty. Because that penalty eventually compounds into interest. And just on a note, you would think, okay, the failure to pay penalty would be more substantial than the failure to file penalty. But it isn't. This is a misconception. If people knew, okay, a simple truth, that the failure to file penalty was 10 times higher than the failure to pay, many more people would file their return just to avoid that penalty, but it's a matter of not knowing what the tax law is. So I tell all my clients, when you get your return, file it. It could be 10, 15, 20. I'm not saying this facetiously. Who cares? Get the return in, and then we have options. If you have your own business, if you don't have certain receipts, we can even have the option of amending the return. But the important thing is that you have to, so to speak, get your foot in the door by having the return filed. Next, you have to pay taxes during the year. You can't pay your entire tax bill on April 15th of 2026 for the year 2025. And that's because the government would go broke. I mean, it needs to have money during the year because the government has to pay its bills just like you do. If you were working for a company and you got $2,000 a week of a salary, and every week you went up to your boss and you asked to get paid, and your boss said, I'm not going to pay you this week. Next week, I'm not going to pay you. Next week, I'm not going to pay you. And then he finally said at the end of the year, I'll pay you $100,000. Most people would say, you got to be kidding me. How am I going to pay my bills? How am I going to support my family? The government on a macro level is like individuals are. They need money during the year to meet their obligations. And if individuals do not pay enough during the year, the government treats that action as individuals taking an involuntary loan from the government, a loan that's not authorized. And if when that happens, an unauthorized loan, or what they call an involuntary loan, the government charges you penalties for doing that and then interest on top of that. So the way I see it is like this. If you owe $12,000, that means you owe $1,000 a month. Pay the $1,000 a month if possible, because you got to pay the tax bill anyway. It's a matter of timing. As long as you have the money that's available, pay it sooner versus later, because penalties are really annoying. It's just like taking money and throwing it out the window. And the penalties are very high. I mean, they're higher than the bank charges. They're higher than credit card companies charge. They're outrageously high. And this is just an easy solution, okay, to avoid those penalties. You got to put the government in a top position as far as your monthly budget is concerned. Otherwise, you'll be paying penalties needlessly, and you'll be just creating more harm for yourself and your family. So it's important to pay your taxes timely. Then the next penalty is the accuracy penalty. If you owe $10,000 in tax and your tax return shows a liability of only $4,000, you'll get hit with an accuracy penalty because it was obscenely low.
You get more people in the room. There's like 10 people in here now.
Yeah.
So,
Okay, so this doctor thought he could just show the IRS a credit card statement, and that's it. Deduction was disallowed. And the deduction was genuine. That's the irony. It was a legitimate deduction that the doctor did not get because he didn't have the receipt. Now, you take another client of mine who basically went to Staples and bought office supplies for his kid for school. That is technically fraud. I mean, but it's like, look, let's this, this is something where it was a couple $100. Okay, so I mean, it's one of those things, okay, that most people do. That deduction passed the IRS documentation test because it was a credit card charge that's at Staples. And the receipt showed books, pens, whatever the heck it is, that seemed reasonable for a doctor's office or an accounting office or whatever. Nobody would know, okay, that was really basically being used for a high school or college student. I'm not encouraging this, but I'm just giving you an example of an example of a legitimate deduction that did not get permitted by the IRS and an illegitimate deduction that did pass the IRS documentation test just because the receipt was there.
solid. Can you do some more of those examples?
Sure. I mean, so here's how the best way to basically get documentation and keep documentation. Most people, when they buy stuff, they don't have their receipt and they just basically throw it in the garbage, what have you. The easiest thing to do is when you get home, empty out your pockets, and put your receipts into a red rope per year. And don't organize it. I mean, the proper thing to do is to organize it, to scan it, to upload it to QuickBooks Online, all that. I mean, I'm a certified online QuickBooks advisor, but most people are not going to have the time to do that. So the easiest thing to do, and there's no excuse for not doing this, is just emptying out your pockets and putting it into a red rope file per year: 2025, 2026, 2027. Then, if you should get audited, you have all the documentation in one place. Because an audit involves gathering those rosebuds, gathering documentation. And if it's in one place, you will save 90% of your time on an audit just by having everything in one spot. Now, if all this wasn't bad enough, the IRS does have penalty relief measures based upon reasonable cause. And there's a whole slew of reasons why the IRS will give you penalty relief. Too many to discuss right now. It all depends on the circumstances of the individual and the business. But the IRS, believe it or not, can be reasonable based upon you submitting a valid application and it being reasonable cause. What comes to my mind is something new that's just being developed in this summer of 2026. And that is the IRS will waive penalties based upon failure to file, failure to pay, if you have a compliance record for the last 3 years that's good, which I think is great. It being reasonable cause. Because what that means is the taxpayer was good, something new that's just being developed in this one year they screw up and they basically get into a situation. The IRS can forgive that, which I think is great. The IRS should be going after habitual offenders and not people who basically have an abnormality in any one given year. So to basically find out more about that, I mean, it depends on the facts and circumstances. I can give all of you a free half an hour consultation and I can determine whether you qualify for that or not. Like I said, to sum up, the most substantial IRS penalty is the failure to file penalty. It's 5% per month. And to sum up, the easiest way to avoid the biggest IRS penalty there is simply by filing the return. It's that easy. That's the best advice I can give. And if you take one thing out of this webinar, take that one thing, because that's going to save you the most, and it's the easiest thing to do. For anything that gets something more complicated, you can talk to me, you can call, and you can make an appointment with Erica, and I'll give you a free half an hour consultation to discuss it in further detail. Again, my name is Frank Kapitza from Frank Kapitza and Associates. It's a pleasure talking to you all, and I look forward to the next webinar, which will have topics designed to save you money before year end.
Hold on, Frank, we have a question. What if you already owe like a ton of money to the IRS in penalties? Like, what are some things you can do?
Okay, if you owe, you could basically negotiate. You can actually do an offer in compromise. It's possible, or you can come up with a payment plan with them over time. An offer in compromise is something that's getting popular right now, but the IRS will only grant an offer in compromise if it feels it can't collect all the money that they're entitled to. If they feel they can, then they will reject the OIC, the offer in compromise, and they'll force you to go into a payment plan with them over 1, 3, or now even 5 years. Okay, they have programs like that, and it's good. That's tough, because if you have to pay prior penalties and interest over 5 years, plus stay current, it's not easy. But unfortunately, people have to pay for their past sins.
Yeah. All right. All right. So, if you want me to wrap it up, or if you have anything else that you want to talk about?
No, then there's also the state of New Jersey. The state of New Jersey works similarly to the IRS. They're tough. They're a powerful taxing authority, but they can be reasonable. You just have to approach them the right way, and they will make a deal with you. They will basically come up with a payment plan with you. And really, okay, the best thing to do is to just not avoid them. If you avoid them, you're going to have bigger problems down the road. Just confront them and just get something worked out that's reasonable, that you can both live with. And that's the best approach.